I think you can take a snapshot in time, maybe a 1 or 2 year period, looking at some standard moving average levels and see if the stock actually reflects that it relies on those. You know, if you find
Welcome back, traders and investors. We have Robert Green on the line, and he's a CPA and founder of Green Nfh Llc. This is a tax and accounting firm catering to investors, traders, and investment management business. Robert, how you doing this morning?
Good. How are you?
We're doing good. So, how did you end up in this specialized area of accounting?
Well, I'm here in New York City, and Wall Street is right next door. And so there's always been traders and money managers. I started in 1983 with Green and Company. By the way, I'm getting an echo on the line. Should I be getting that? A replay.
Yeah. Do you have your
my headset's on?
Okay,
Sorry,
maybe
everyone.
just kill the show if you have the
Oh, okay.
Yeah, kill the show, and that's probably what the problem is.
Good. Sorry about that, everyone. Okay, so I've always been interested in the investment business. It's where the money is. It's one of the best industries around. And I've always serviced money managers, Forex brokers, Forex traders. But in 1997, Congress changed the laws to say if you're a trader, you can write off your losses as an ordinary business loss. Going into the tech wreck, I thought that was very important. So I kind of got the message out there. It's a free election. It's like having tax loss insurance. Otherwise, traders get burned by that 3,000 capital loss limitation and stuck carrying over their losses. So that's how we expanded nationwide over the internet, where it wasn't just your Wall Street professional trader, but all your online traders that all of a sudden were interested in what we had to offer.
Yeah, that's very interesting, and those laws are still in effect today, right?
Yes.
Okay, because if it reversed, that could be bad news for traders as well as the business. So tell us, I know you do a lot for hedge funds, and you manage. You said you expanded things. Just give us who are your clients besides the hedge funds?
Well, most of our clients are online traders. They're the ones that listen to your show, trade at home. So many people are being, I guess, displaced in this economy. They're laid off. They're looking for a job. They want to be an entrepreneur. They want to trade on their own. So if you trade on your own from home, you have a lot of things to deal with. Tax treatment, for one. Whether something is the lower 60/40 tax rate for futures or whether it's taxed at the regular ordinary rates for short-term capital gains, the tax rates are up to 12% difference. That affects all investors. Cost basis reporting, you get those 1099s. They do a very confusing job on the wash sales. They don't do it according to the rules for taxpayers. That affects 10 million online trading accounts. So those are our clients. Hedge funds is a small slice of the marketplace, and we've put a lot of smaller traders into business with new hedge funds. You have the big law firms that deal with the big hedge funds. Our outside attorney, the investment law group, handles formation of the smaller funds, and we do the accounting and tax compliance. And we have another partner that does the assurance, the auditing. But for the most part, we're focused on the investor active trader.
Okay, so let's say you are the investor. Let's say you want to get started, okay, that you've set aside some money that you're willing to give up to the market gods, and you want to get started. Should you do anything beforehand, or should you set yourself up in a way that would help you things farther on down the line as far as for tax reporting purposes?
Well, most people choose between securities, futures, or Forex, or other instruments. They're taxed differently. Futures have summary reporting. You get a one-page 1099, lower tax rates. It's very easy. Securities, you're going to need software like our trade log software. It's third-party software to download your trades, to do the line-by-line accounting. But most people are just going to open an individual account, perhaps a joint account. Now, if you also trade securities in an IRA, caution, there could be permanently lost wash sales between your taxable securities account. If you buy it back have a loss and you buy it back 30 days before or after, you can permanently lose that loss because it goes into your IRA. So most people are starting as individuals. Now, if they feel they're going to trade as a business, and we have a list of golden rules, for example, make 1,000 trades per year annualized. That's about 4 trades a day, 4 to 5 days a week. That's a lot of trading. If you're going to trade at that level, that's considered a business. And then you're allowed business expense deductions, including for education, all your equipment and home office, and margin interest. And it's better to conduct that business in an entity where you then also can arrange to have employee benefit deductions like health insurance and retirement plan. Add it all up, the business expenses save you $5,000 to $10,000 a year. The employee business deductions save you another $3,000 to $10,000 or more per year. And that tax treatment election that I mentioned before, that's only available to the business trader. And that can save you thousands more. So it's serious money. So start perhaps as an individual. See if you are trading enough to be considered a business. And if you are, consider an entity.
Okay, and to do the trading in, when people get set up, and is there things that they do like right off the hop that it could really cause either cause problems farther down the line if they don't take care of it properly, or things they can do? I mean, you mentioned setting up as a business. What are some of the pitfalls that people run into if they get started? Let's say they make a lot of money quickly, and they don't go about the proper way setting things up.
Well, one big pitfall is making money in 1 year, make a lot of money. You don't pay your estimated taxes. Maybe you don't have to. You have a safe harbor exception. You made a lot more than the year before. And then you lose your money in the first quarter of the year. And you don't elect that tax loss insurance. And you get stuck with a capital loss. And you lost your tax money. You can't pay it. Another pitfall is you're trading securities and you're triggering wash sales between accounts and your IRA, and you don't even realize it, and you don't find out about it until it's tax time, and that gave you all this phantom income because you couldn't deduct losses, and you get stuck having to pay the IRS and state, and you feel, why should I pay them? I didn't even make money. Or maybe you lost money and think you don't have to file, but the IRS gets a 1099 and sends you a jeopardy assessment, a made-up number. That's an outrageously high number, which you get very upset about, and they compel you to file. So it's important to get your tax affairs in order early. When you have a job, you get a W-2. When you have interest in the bank, you get a simple 1099. It's a lot more complex with trading. Your expenses are not on a 1099. And where to deduct them is not clear. And a lot of your income is very confusing. Is it Section 1256 contracts or securities, line by line, securities, a mark to market or not, or just realized? People can get very confused with the accounting and the tax treatment and how to deduct their expenses. Can they deduct in education or not? It's pretty confusing. And if you are not on top of it, and just rely on a local tax storefront or a local CPA, you may leave thousands of dollars on the table and have tax problems.
Yeah, it's something you definitely want to avoid. Is there any instrument that's better to trade than another? I mean, you mentioned the line by line item for stocks, and believe me, I have gone through some hellish accounting sessions trying to figure out my taxes with the stocks and the even with the K1s and things like that, it can get very difficult. I mean, is there one investment vehicle, from a tax standpoint? I mean, futures could be pretty nice.
Yes.
Yeah. What do you recommend along those lines?
Well, your Section 1256 contracts, which include futures, broad-based indexes, options on indexes, any regulated futures contract, it's summary reporting, it's mark to market, and you get a simple one-page 1099 that you can rely on. And there's lower 60/40 rates. 60% is a long-term capital gain, even on a day trade. 40% is short-term. The long-term rates are lower, so when you do the blended math, it comes out to the top rate of 28% versus 39.6, about 12% difference. And if you have a loss in a given year in 1256 contracts, you can do a loss carryback election. You don't have to elect it in advance like Section 475, that tax loss insurance I talked about earlier. The 1256 loss carryback election you can do when you file your return. If you were filing your 2013 tax return before Wednesday, the due date this week on extension, you could check the box up on top of Form 6781 to do the loss carryback, but it can only be carried back 3 years against Form 6781, which is Section 1256 contract income. You can't offset it against other types of income, which you could with that other Section 475. So futures have easier accounting, lower tax rates, simple reporting, and flexibility with losses. Securities are the ones that have the wash sale treatment, the capital loss limitations. But that's why it's important, if you're a business trader in securities, to elect Section 475 mark to market, because that turns on the ordinary business loss treatment and it exempts you from the wash sales. So that's a very powerful election, the Section 475, and traders can learn more about it in our Trader Tax Center at Green Trader Tax.
Okay, all right, good explanation of that. So you see people, coming in and out of the industry, quite a bit, obviously. What words of advice do you have for people, outside the tax, implications of things? I mean, for people that are coming into the market, I mean, you see the bottom line. I mean, you see the returns. I mean, what would you say, like, are the percentage of people that just, come out, let's say they got laid off for a job or retirement from that? What kind of trends do you see as far as the profitability in traders?
Well, there's a lot of turnover, and there's a lot of the big fish stories. When we go out there on the radio shows and places like this, a lot of people are out there with charts showing people how to buy low, sell high, and the reverse. And if you listen to what I just discussed, I focused a lot about expenses and losses, because I'm sure it's at least 50% that are losing money. And we've handled big shot brokers our entire life, and it's amazing to me how many of them have capital loss carryovers. So there's a lot of tall tales in the marketplace, and we deal with the reality of tax returns. So I think it's important to be very realistic about the amount of capital you have and the returns you can generate. To think you can open up a patent day trader account for $25,000 for 4-to-1 leverage margin to day trade, and that you're going to make $50,000 is very unrealistic. Investment managers, the best ones, have returns of 20% or even less. They don't have 300% returns. So I think you need to be realistic. You need to discuss it with your family, use discipline, and that's the name of the game. Take your losses early, be very disciplined. It's not for everybody. It's a great activity to be able to do on your own. You don't need customers. It's fantastic. But a lot of people lose money, and when it's time to stop, you should stop. So it's important to be cautious and positive.
Okay, one, yeah. So you could pay your accountant, right? One quick question here about when does a actual loss occur with a stock, and I hope this is just one last question for
Yes,
you here.
when it's realized.
When it's
With a
realized,
Yeah,
okay.
when you sell it. With a future, it's mark to market. But if mark to market's not baked into the cake, then it's when it's realized when it's sold.
Okay, so if you buy 1,000 shares and you dump 900 of it right there at a loss, you have to report the loss on the 900 of the 1,000, right? And just
That's correct.
until it's completed. Okay, all right, we're going to let you go here. Any final words of advice? You've covered a lot of different aspects of accounting for traders and investors. Is any other final tips you'd like to give our listeners?
Well, just get educated on the tax treatment. That's important beforehand. Do your year-end planning now. It's a good time to do it. There's still time for an entity. And just come to our website at greentradertax.com. There's a whole lot of free information and excellent premium information too. And we give expert advice and do tax compliance services.
Okay, you got to pay the government. That's one way or another. All right. Well, Robert, thanks a lot for coming on, discussing a topic that's very important, taxes and accounting. Robert Green, CPA, founder of Green LLC, special guest here on Benzinga's Pre-Market Prep, brought to you by Charles Schwab. Thanks a lot, Robert, and have a good day.
Thanks.